Hello, everybody. My name is Bob Klefsis. I'm president of All Star Financial. I want to welcome you to the All Star Financial Quarterly Review 2017 webinar for the second quarter. Title of our newsletter as well as our webinar is Calm Markets Continue to Trend Higher in the Second Quarter. Will that continue is the big question. Before we get that, I'd like to invite you to meet three great professionals, our new teammates. We've grown from 6 years ago, or six teammates 5 years ago to 12 today. Matt Burhow brings in 15 years of experience, CFP, AIF designation. Brady Mikulajczyk, great associate wealth manager with his CFP, used to work with Ameriprise. And Caitlin Buckley brings 11 years of the banking world experience to client service associate. Back 30 years ago when I started All Star Financial, I promised that I would be here for my clients and for forever. I have an 88-year-old client. He was one of my first 5 clients. I want to make sure that if he continues to live 40 years and I'm not here, that certainly All Star Financial is here. So we've got a great team and really excited about the teammates that we've added. Market overview. Calm markets, as we talked about, trend higher. A lot of low volatility. We think this needs to change. We've seen some domestic equity returns in the technology world that have been phenomenal, but driven by very few stocks. The FANG stocks, Facebook, Amazon, Apple, Netflix, and Google, make up almost 42% of the year-to-date returns of the NASDAQ market. Legislative initiatives have failed to materialize, so again, there's some concern there also. But one of the bright spots of the market overview would be our international exposures. Emerging markets and developed Europe has been up over 6% the last quarter, up 15.4% in Europe year to date, and over 18% year to date on the emerging markets. So bringing to the table that I think from the U.S. Market, what we want to do is understand the economy. We're right now in an 8-year bull market. Unemployment is low, which is usually the case in an expansion type of market environment. Wages have risen, which is also indicative of a market top or expansion economic top. GDP is just kind of wavering. Quantitative easing helped GDP up and down, and now we're really in need of you and the government to start spending a little bit of the maybe tax reform and infrastructure money. That's going to be the real big benefit. Don't have a lot of inflation right now. It's below that target of 2%. But for us to go forward, really politicians need to be able to play nice in the sandbox going forward. We look at the Fed, it still believes that there's continued ability for the economy to grow in the United States. We think that that's suspect. Unless we get some type of work in Washington done. If we look at the bond market, and interest rates tell a big time story. The yield on the 10-year Treasury actually is coming down when interest rates are rising on the Fed. We would believe that the bond market kind of probably is correct. We saw a little bit of a drop of interest rates from 2.4 to almost 2.3%. Barclays aggregate index was up about 1.5% as a consequence to rates coming down. The government bonds were up about 1.2%, still down about 1/10 of 1% for the year or the last 12 months because rates have come down over that time period. High yields have earned another 2.1% in their total return. Emerging markets were flat, but up about 6.2. Emerging and high yields have been probably some of our better performers. High yields up as much as 17% the last 12 months. Looking ahead, when we see the raises of interest rates that the Fed has done since 2015, it's gone from 0.25 to 1.25. Can they continue to do that? There's something called the flattening yield curve, where the long-term rates have not gone up. We think that that's an issue that if it gets too close to being flat, that's prelude basically to a recession. So they have to really be thinking long and hard about what's going on there. We talked a little bit about the domestic market and the bull market run that we're in. We're getting closer and closer to a correction in our minds. Since the bottom of the market in 2009 in March, we've had 7 corrections. of 5% or greater. The average length in between those corrections has been 16 months. Right now, we're 16 months from our last correction of February of 16, where we took a 13.2% drop. So again, something has to happen. We need to have, in addition to the positive economic data and the anticipated fiscal stimulus, we need to have those things come to light to make these all-time highs really realistic. In addition to that, we have had some growth on the corporate earnings. 15.5% growth on the first quarter relative to previous quarters, and technology and financials and materials have all been positive 20% or more as far as the profit growth relative to 12 months ago. Our large cap stocks outperformed small cap stocks about 3.1 to 2.5. Growth outperformed value 4.7 to 1.3, which again, looking forward, we see the S&P 500, has dropped relative to its expense. It's pretty high, still higher than the average. Does healthcare and technology have the ability to drive all of this without some type of tax reform is really the big question. Global markets going forward, they have been synchronized for the first time in many, many years, where we're seeing everybody around the world grow, which can be good, can be bad. That steady growth of international developed markets has been a positive impact on the emerging markets. The MSCI Europe Index has gained over 7.4% quarter to date, almost 15.5% year to date, and the emerging markets benefit from Europe has been 6.3% this last quarter and over 18% year to date. Looking forward, we think that the international valuations still are cheaper than the U.S., still have some room to run there, so to speak. However, the global economy and this advancement of in a synchronized manner will give the domestic market a little bit higher growth than maybe it should. But if things don't transpire, we're going to see a little bit of a hit. So where the internationals won't go down quite as much. In summary, we want to conclude by saying that, hey, be prepared for a little bit less predictable and more volatile markets. We're seeing domestic bonds, international bonds, domestic stocks, international stocks for the first half of the year do some unbelievable things, right? Non-U.S. stocks still have some better strength around the globe. But as always, when everything's good, we're looking at how do we take chips off the table and mitigate risk and minimize your downside risk. So we want to make sure that you understand that we are looking at a lot of things. Internationals have been one of our overweights, has really benefited you the last 6 months. We see 17% gain since the beginning of the year on the emergings, 12% on the Europe, and only 7% domestic. From the bottom, domestic markets have outperformed internationals, both Europe and emerging, significantly, so we still have some room to run there. We talk about valuations. Emerging still very cheap. Europe is getting a little bit more expensive and a little bit over average. But you look at the U.S. market, it's significantly over average. Here, this is interesting. When the world is set up, domestic and international, 20 years ago, it was 80-20. Domestic took on 80% of all the market wealth around the world, and internationals were only about 20. Now it's 53 to 47, so it's almost a 50-50. Well, there's not a lot of investors that have a 50-50 split. We do. For the first time in 30 years, we almost have exactly 50% of our equities are domestic and 50% are international, which again has helped you quite drastically here in the last 6 months to 9 months. A couple things for fun on our newsletter. We talk about place to go, Adele's frozen yogurt. It's scrumptious. It's butter in a cup has been defined by one of our employees. Baby back ribs recipe from Joseph, one of our interns, intern number 99 actually, over the last 30 years. And then one of my favorite people to quote, Winston Churchill, said at one time, we make a living by what we get. We make a life by what we give. So with that in mind, I hope that we are giving you from a team standpoint what you deserve. And as a client of ours in need, remember that referral program would be great to get a couple names from each one of you to help us continue to grow. And our staff right now is growing to service you. Again, my whole goal is to uh, you guys outlive me, but you guys don't outlive All Star Financial. So thank you very much for your time. Again, a sincere belief that we serve you, and please give us a call whenever we can do anything for you. Have a great day.